We're looking at 4 stocks that analysts say have between 50 to 150% upside over the next 12 months. We're going to take a look at each company's historical performance. We're going to analyze some of their financial metrics over the last 10 years. And as always, we'll run them through the valuation model to get to our own intrinsic value, get to our own acceptable buy price given our investor margin of safety, and look towards Wall Street to see what they forecast exactly over the 12-month period. Now, before we start with the first stock, just to let you know, these stocks will not be for every single investor. These are stocks which have been battered down. A lot of them do have negative free cash flow and not the greatest financial metrics. However, these are the companies where you could see some strong value plays where they do turn around, and hence why some of these analysts are targeting significant upside. As you know, with the typical blue chip companies, you will not be expecting these massive gains. So the first company is Warner Bros. Discovery, ticker symbol WBD, down 32% over the last year. Now, when we extend that over the last 10 years, we can see it is down 76.4%. And we can see its all-time high is sitting around that $70 to $80 mark in March 2021. It's currently trading pretty much at their 52-week lows and has a market cap of $24 billion. So in terms of their metrics, so let's look at the free cash flow data. As always, I tend to ignore the earnings. It is susceptible to manipulation by management through accounting. $2.04 in 2013, $1.71 in 2022. So it's been on a bit of a roller coaster after the last 10 years, but we can see over the longer term, in fact, negative growth. But in more positive news, 2023, 127, so it is expected to drop further, but 2024 to go higher to 241. So very inconsistent on the free cash flow per share. In terms of the sales growth, what we typically target here is 3 to 7% growth year on year. The last 2 years have been very strong. In fact, 2022, 3 digits gain, 177%. 2023, 62% expected. So it does look very positive in the more recent period. Then numerically, for those that like to see the numbers, $5.5 billion in 2013, $42 billion in 2023. So some strong growth, although we know pretty much from 2013 to 2021, it is very inconsistent. Nonetheless, it does still move in the right direction. Now, not in great news, shares outstanding. Whilst we do love share buybacks, what we can see is the opposite. They have diluted your position as a shareholder. From 2013, it's gone from 812 million shares to 2.44 billion. In terms of the metrics, well, ROIC, return on invested capital, what I personally like to see for these metrics, around 10% or more, gives me faith that management are able to effectively allocate their capital. And for those who want to see the other 6 golden dividend metrics, we do free weekly newsletters. If you want to gain access to this one completely free, click on the pinned comment below. Other articles we do discuss. In fact, the latest one, we ran through companies where insiders were buying a lot of their shares, as well as companies where insiders were selling a lot of them as well. We can see with the ROIC, it does start to drop over the longer term. 7% in 2021 is okay, not really great, but 2022 and 2023 in negative isn't something we want to be seeing. But again, that share price has been hammered over the last few years, which makes sense when looking at some of these metrics. Operating margin, so we can see they did make a loss in 2022 and 2023, hence the negative percentages, and it has also been decreasing. Although in more positive news, the free cash flow margin, we look for around 7% or higher. Still, after the drop in 2022 and 2023, it is higher, 13% in the more recent year, although we can see again the free cash flow margins dropping year on year. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Now, these show us the number of years it would take the company to pay off all of their debt net of cash on hand. Gives us some sense of security over the balance sheet. 2022 pretty high, 2023 and 2024, nice to note it has come down to around the 4 level. Ideally, we want to see around 3.5, so not the worst, but something just to keep an eye on. So in terms of the valuation for Warner Bros. Discoveries, let's jump in. And as always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So typically on this channel, we do deep dives and we run through every single one of these models. For today's episode, we're going to jump straight into the intrinsic value calculation. And what we can see, the intrinsic value for this company is derived from the DCF model only, coming to around $15.72. Now, when we get to the margin of safety, we typically start off with 10%, which we use if we believe it has a wide moat, strong financial metrics, good forward-looking data. And we keep going until nearly the current trading price to see what margin of safety we have on this company. And we can see for Warner Bros. In today's episode at a 40% margin of safety, it isn't quite there yet. So we see at least a 35% margin of safety. In terms of Wall Street for stock number one, they see 58% upside with a price target of $15.75. As always, when we go through these companies, do let us know if you have been buying or if they're on your watch list. And as I did mention earlier, a lot of people may not like these stocks given the fact that their metrics have been fairly poor. But again, as we mentioned, analysts are targeting a significant amount of upside, which will only increase as we move on now. So the next stock that we are taking a look at is WW International Weight Watchers. Over the last year, up 4%. Over the last 10 years, down 79%. And we can see their all-time highs in 2018 of around $100. They're trading towards the lower end of the 52-week low with a market cap of $359 million. So taking a look at some of their financial metrics, their free cash flow per share has gone from $4.66 down to around 55 cents in 2022. 2023 expected negative 57. So again, not the greatest. We can see that, in fact, over the last 10 years, their free cash flow per share has started to decrease. And whilst we don't have any expectation for 2024 just yet, when we do look at the earnings per share, we can see that it is expected to rebound from 2023. So we may be expecting the same thing from the 2024 numbers for the free cash flow per share. Sales growth pretty poor, in fact negative growth for the majority of the last 10 years. It only had 2 of the last 10 years where it had positive growth. And when we look at the numbers, we can see in fact it has gone from around 1.7 billion to 908 million. Shares outstanding, well, they have also, as we can see here, diluted your position, 56.4 million in 2013 to 74.5 million. ROIC, not too bad for the metrics we have seen above, 10% or more. The last 2 years at 18% and even 2023 at 14% is still a strong number. Operating margin, free cash flow margin, again, not the worst. We want to see around 16% here. So 2022 and 2023, it has slipped slightly under, but before then, it was a fairly healthy margin overall. Free cash flow margin, again, pretty similar. It is inconsistent. We want to see 7% or more, which it has got for the majority of the last 10 years. Although we know in 2022, it did slip down to 4%. 2023, as we saw above for the negative free cash flow, that margin of negative 5%. Net debt to EBITDA, you don't really, for these type of companies, want to be seeing more than around 5.5. 2022, it was slightly higher. 2023 expected 8.12, so that is very high. Some worries here around the debt level, although 2024, it is expected to come down to 6.97. So what about the valuation then? Obviously, this has been included in the episode because Wall Street analysts are targeting some massive upside. So due to the DCF model, we get a price of $9.73. Intrinsic value, again, it is just derived from this model. Margin of safety then, we start at 10% where it is a buy up to $8.76. And we keep going till it's near the current trading price. And we can see for today's episode, it is around that 50% level up to $4.87. Now again, just because of margin of safety, even if it was to say 90%, it doesn't necessarily mean it is a buy. You need to understand why a company has dropped so significantly. And just because, as we're about to see, even when Wall Street see a lot of upside, 149% in fact for Weight Watchers International with a price target of $12, it doesn't necessarily mean, again, you should buy. You always need to do your own due diligence. And the purpose of this video is just to show some stocks that we haven't necessarily covered on the channel before to see whether or not they fit your thesis and whether or not this is something you want to look moving forwards. We then move on to the third stock with some significant upside. We have ChargePoint Holdings. Over the last year, they are down around 83%, and we can see over the last 5 years, they did peak up in 2020 at around that 45 to 50 level mark. It is trading as well at the 52-week low with a market cap at just under $1 billion. Moving on to the financial metrics and the free cash flow per share. Now, what's nice to note about here is that the free cash flow, whilst it's negative in 2018, every single year it has been reducing significantly. 2024 expecting 40 cents. So I would like to see this in 2025 and beyond start to turn free cash flow positive. And we can see now where the value lies with companies that maybe aren't doing too great, but if the expectation and guidance for the future is for them to start performing a lot better, then these are the companies that we can see a lot of share price appreciation very rapidly over a year, 2 or 3 period. Sales growth as well looking pretty strong. 2021 we see just a single percentage, but the other years beyond that we see very, very strong double-digit growth. 2023 94%, and when we look at that to the top line, 62 million in 2018, 544 million on the trailing 12 months, so some incredible growth. We also note they have increased those shares outstanding significantly, 1.9 million in 2018 to 356. ROIC then we can see negative. They aren't making a profit just yet, so they have a negative ROIC, negative 50% in the more recent year, and that is shown here by the operating margin, which in the latest year negative 73%. Likewise, a very similar story on the free cash flow margin. However, one positive thing to note, the net debt to EBITDA 0.16 in 2023. So they do have a strong balance sheet. They don't have a lot of debt, especially in comparison to that cash position. So no real worries at the moment. And hopefully this is one where it can start to become free cash flow positive very, very soon. So in terms of the valuation, let's get into that. And don't forget, you can grab a copy of this model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and on your watch list. So a margin of safety of 10%, we can see a buy up to 234 at 15%, pretty much around the current trading price. So we see a 15% margin of safety. Wall Street and their targets, they see 49% upside with a price target over the next 12 months of $3.28. We then move on to the next stock, which is Planet Labs PBC. Now they're down 53% over the last year. They're trading at their 52-week lows. And again, we can see over the last 5 years, they have peaked at around that $12 mark in 2021. And we can see their market cap $650 million. Now looking at their financial metrics, similar to the previous company, they are free cash flow negative. However, they have started to improve their position over the last few years. To the negative 32 cents in 2023, expected negative 23 in 2024. So this is something I do quite like to see. Even if it is very poor, they are moving in the right direction and it is very consistent year on year. Nice strong double-digit growth year on year. 2023, the more recent period, 46% to the top line. And it's gone from 96 million to 215 on the trailing 12-month basis. They have, however, increased those shares outstanding, 43 million in 2020 to 275. ROIC negative. Again, they're not profit making just yet, and we can clearly see that with their operating margin in the more recent year at negative 92%. And likewise, their free cash flow is negative, so we are expecting this free cash flow margin to be negative too. Net debt to EBITDA 7.7 in the more recent year. That is pretty high. 2024, however, expected to go even higher at 12.26. So this is some cause for concern and something you should definitely take a look at before making any investment. So let's jump into the actual valuation to see what Wall Street analysts are targeting and what we're getting as our intrinsic value. We're getting to a price of around $4. So in terms of the margin of safety, again, we start off with that 10% until we get near the current trading price. And we can see even at a 40%, it is still a margin of safety that is acceptable. Not quite there yet, a few cents shy. So we see around a 40% margin of safety. In terms of Wall Street and their expectations, well, they see a price target of $4.71, upside of 108%. So they do believe there to be a lot of upside with this company, similar with the last three. As always, let me know your thoughts in the comments below. A lot of people, again, may not like this, I understand. However, this is something we're doing that's just a little bit different. If you enjoyed this type of content, let me know in the comments below. I can find some more very high upside companies. But as always, enjoy your day. Smash that like button if you enjoy the content. Hit that subscribe if you want to be continually notified of these videos. And as always, see you on the next one.